Hey ladies and gentlemen, welcome to andcrypto. In our last video, we explained not all layer 1 chain has survived. So which one has survived? And we understand that layer 1 chain needs good projects on the chain to attract users. You already understand that this requires a strength that the Ethereum ecosystem does not have. Today, based on a project, I will explain Avim, a project to attract institutional investors to DeFi, which has strengths that the Ethereum ecosystem does not have. In this video, we'll first discuss the interest of institutional investors in DeFi. How many institutional investors are actually coming to DeFi? What are the bottlenecks? And finally, we'll discuss Avim. But before I get into it, please make sure to smash the like button and subscribe to the channel. Institutional investors are coming. The entire crypto industry, including Bitcoin and Ethereum, is currently in a bear market. Bitcoin is down 70% from record highs and Ethereum is down 70% as of 15th June 2022. The crypto asset industry experienced a crash as well in 2018, with Bitcoin falling more than 80% from its 2018 highs and Ethereum falling more than 90%. While there are countless ways things are different from them, the important thing for the crypto industry is that the institutional investment is coming into DeFi. Why are institutional investors coming? Institutional investors are actually coming into the crypto industry, which until 2018 was mainly private investors, and their numbers and amounts are much higher than in 2018. In 2021, institutional investment via Coinbase alone increased to $1.18 trillion, 10 times the amount in 2020. Interest from institutional investors is also increasing, with one report showing that over 80% of institutional investors are permitted to have exposure to crypto assets. Infrastructure is building. So why is there such an increase in interest and investment from institutional investors now compared to investment 2017 to 18? It is because the infrastructure for investing is being created at a level unmatched in 2018. The main categories are: number 1, exchanges; number 2, borrowing; number 3, custody. Number 1, exchanges. In 2017, most exchanges were for retail investors and many of the CEX were just starting to develop their services for institutional investors as of 2017 to 18. Now, Coinbase, FTX, Binance, and other leading CEX have grown to the point where they can handle the $1 billion to $100 transaction volumes required by institutional investors on a daily basis. Institutional clients are trading huge amounts on these platforms. In addition, these exchanges are expanding into developed as well as emerging markets. Africa-based VLR has over 500 institutional clients. Number 2, borrowing or lending. The development of infrastructures, services to solve DeFi's lending services problem is also much more advanced than in 2017. And Goldfinch Finance has been able to reach a non-crypto native audience and an over-collateralized two of the challenges to provide zero collateral loans to real-world approved individuals or businesses, thereby addressing both of the limitations of crypto lending protocols. Maple Finance also provides direct access to high-yield, low-collateral loans. Existing and already successful DeFi projects are also planning to reach out to institutional investors, with Avem launching Arc, which will thoroughly enforce KYC and AML, and Fireblocks providing a platform that offers a backend solution for seamless integration of custody and DeFi, which already has more than 30 institutional customers. Number 3, custody. State Street and BNY Mellon, two of the world's largest custodial banks responsible for the custody of nearly $15 trillion in assets, are adding custody for crypto assets starting in 2021. Currently, the crypto asset industry includes prime brokerage and services for large clients does not exist. Major crypto asset exchanges, trading firms, and custody companies are aiming to offer this service, and it appears that BNY Mellon Island is also aiming in the direction. This encourages institutional investors to enter the crypto asset industry. VC investment to Web3 startups. In US, institutional investors typically allocate several percent to several dozen % of their portfolios to VCs. This means that indirectly, the amount invested by VC in the crypto asset industry is the amount invested by institutional investors. Allocations from institutional investors to VC are increasing every year. In 2017, there was less than $1 billion invested in crypto assets from VC. But in Q1 2021 alone, there was 11 times that amount. Aside from what has actually been invested, Parachain and A16Z alone could drop nearly $5 billion from the funds raised in 2021. Despite this growth, even the $33 billion capital deployed in crypto companies is only 5% of the total venture capital deployed in 2021. So there is a still upside. Needed to drive the TradiFi to DeFi flow, develop ZKP, address CBDC, and with regulatory relationships. So many institutional investors are interested in the crypto asset industry and are actually investing. And the amount is exploding every year. So what needs to be done to further encourage institutional investors to accelerate their investments in DeFi? I believe that ZKP, Zero Knowledge Privacy, CBDC, central bank digital currency, and regulatory compliance are key. Development of ZKP. Companies are not convinced to adopt a public ledger with a privacy consideration. Institutional investors are no exception. Zero Knowledge technology is a breakthrough that allows companies to leverage public ledgers while preserving sensitive data and information details. Privacy is essential for enterprise users, but it is difficult to achieve with the current public chain. The crypto asset industry benefits from transparent markets and liquidity pools. Centralized exchanges and other tools impose the same condition on all players. ZK technology is making progress in bridging existing enterprise backends directly to established chains, such as Ethereum. EY is making progress in this area and has announced Nightfall Ver3 for 2022. It is open source and in the public domain and can be used by anyone. This development will hopefully turn into a scalable private transaction ecosystem that can run on public Ethereum. Addressing CBDC. Nations are likely to release CBDC this decade, and many are already in research, demonstration, and pilot status respectively in many countries, and are seconds away from being released. Widespread adoption of CBDC means exponential growth of on-chain data assets. Not only CBDC or crypto assets, but also traditional stocks, bonds, and etc. can be exchanged for CBDC or crypto assets. This means that DeFi will receive the liquidity of conventional financial assets on the on-chain, which will be important to attract institutional investors to CBDC. Regulatory affairs. State regulation is often used to police the crypto market. The timing and exact details of regulation are not yet known, but it is likely that the broad DeFi project will split into regulated permission and permissionless markets. As mentioned earlier, Avem has launched and offers a pool of permission-based products that all users can use to meet existing KYC and AML compliance frameworks. As the field matures, it would not be surprising to see these permission-based protocols incorporated into key protocols in the various Layer 1 ecosystems. This will not eliminate existing permissionless DeFi usage from the market. Users and businesses alike are likely to seek jurisdictional freedom when governments restrict access to financial tools that will become increasingly important in the coming years. Permissionless DeFi is like a virus, and governments around the world have already proven unable to slow the spread of viral information and disease. You will be free to trade in either the permissioned or permissionless market. There must be some compromise between a regulated market and a completely free market in order order to attract institutional investors. Fortunately, the open and verifiable nature of cryptos is likely to provide individuals and companies with the tools to facilitate these negotiations. DeFi audits and risk assessments will be conducted in real time, and the ZKP will allow companies to prove compliance without having to disclose information that would make them competitive in the marketplace proof of compliance. Why can Avem play a role? What is Avem in the first place? Here is finally an explanation about Avem. Avem is an institutional DeFi infrastructure built as a Layer 1 blockchain. The chain is being developed on the top of Polkadot, and Avim is a parachain in the Polkadot ecosystem that can offer financial banking products to both retail and institutional users in interoperable and scalable manner on a customizable ledger. Headquarters is located in Switzerland, where there are many family offices and institutional investors, and envisions a DeFi infrastructure chain suitable for them. The project is currently in seed stage. As mentioned earlier, ZKP coverage, CBDC, and regulatory requirements for attracting institutional investors to DeFi will all be handled at the chain level in compliance with Switzerland and FINMA laws. It is expected to bring institutional and family office clients to DeFi while complying with Swedish and FINMA regulations in a permissioned market. Furthermore, KYC and AML compliance frameworks can be adapted to the chain itself, offering services that can only be deployed in a permissive system. Differences from big DeFi players. However, even if Avem cleared the ZKP, CBDC, and regulatory-related issues, we have not accounted for the competition aspect. How will Avem differentiate itself from Av, Compound, and the Fireblocks, the DeFi players already successful and trying to secure institutional investors mentioned above? Avem is a Layer 1 chain, unlike other DeFi projects, and differentiates itself from the Ethereum ecosystem. Unlike other DeFi projects, it is a Layer 1 chain. The DeFi projects I mentioned earlier are dApps, not a Layer 1 chain. Avem is a Layer 1 chain, so it can offer nominated collaterals and institutional notes to institutional investors. For example, Uniswap, the most famous DEX, can only give back swap fees to LP providers, while Layer 1 chains can offer tax fees and MIVs to users at the same time. This makes it advantageous for institutional investors to use Avem, which is developing a Layer 1 chain with the advantage of fees. It means that the incentives can be adjusted to be more attractive and user-friendly in the long run. Differentiation from the Ethereum ecosystem. So far, I explained why we should invest in Layer 1 chain, and not all of Layer 1 chains survive. So which will be survived? The conclusion was that Layer 1 chains are the most profitable and lucrative, but that is only possible with promising projects that have a large number of users on the chain. Emerging chains will not flourish without promising projects that can attract users. Avem is a permission-based marketplace. Avem is attacking the market in a way that Ethereum does not. As explained above, the permission-based design and compensation design unique to the Layer 1 chain allows it to bring in more institutional investors. Last but not least, it is only a matter of time before some of the TradiFi's investment is turned over to DeFi. The current crypto market is $1 trillion as of 16 June 2022. And if 1% of institutional investors' portfolio were to turn to crypto, that would be about $3.5 trillion, more than 3 times. The key in today's bear market is not to be swayed by the market, but to encourage investment in technology, growth, and innovation. I hope you found this video interesting, and as always, if you enjoyed this video, smash the like button and subscribe the channel.